By the time the system reaches this stage, the tension is no longer hidden in balance sheets or buried in credit agreements. It begins to surface in decisions that companies can no longer delay. Projects are cancelled, not because they are unprofitable, but because capital is no longer available on acceptable terms. Hiring freezes appear in sectors that were expanding only months earlier. Executives shift their language from growth to preservation, from opportunity to discipline. These are not isolated signals. They are coordinated responses to a constraint that is tightening across the entire corporate landscape. The analysis at this point moves beyond individual firms and into the structure of capital allocation itself. For years, the availability of cheap debt created an environment where capital flowed freely, often prioritizing scale over efficiency. Companies could afford to operate with lower margins, higher costs, and longer timelines because financing those gaps was inexpensive. But when the cost of capital increases, the criteria for survival changes. Efficiency becomes critical, cash flow becomes central, and companies that were optimized for growth under one set of conditions find themselves misaligned with the new reality. A common misunderstanding emerges here. When companies begin cutting costs or restructuring, it is often interpreted as a sign of mismanagement or sudden weakness. In reality, many of these companies are responding rationally to external pressures. The system they were operating in has changed, and their behavior is adjusting accordingly. The problem is not necessarily the decision to borrow in the past, but the scale at which borrowing became normalized across the system. When too many participants adopt similar strategies under similar assumptions, the entire structure becomes sensitive to the same set of risks. The hidden system driving this phase is the interaction between corporate debt and market liquidity. In stable conditions, liquidity is abundant. Buyers and sellers interact smoothly, and assets can be priced efficiently. But liquidity is not a constant. It is a function of confidence and participation. When uncertainty increases, participants become more cautious. Buyers demand discounts. Sellers become more urgent. The gap between what sellers need and what buyers are willing to pay begins to widen. This gap is where volatility emerges. Evidence of this can be observed in the behavior of credit markets during periods of stress. Bid-ask spreads widen, trading volumes become uneven, and price movements become more abrupt. Instruments that were previously considered stable begin to exhibit unexpected fluctuations. This is not necessarily because the underlying assets have changed dramatically, but because the willingness to hold risk has declined. Liquidity, in this sense, is not just about the availability of capital. It is about the willingness to use it. The implications of declining liquidity are significant. When companies or institutions need to raise cash, they may be forced to sell assets at unfavorable prices. These sales can create downward pressure on the market, affecting the valuation of similar assets held by others. This process, often referred to as a form of contagion, does not require direct connections between entities. It operates through pricing mechanisms and shared exposure. What affects one part of the market can quickly influence another, even if the underlying fundamentals differ. As this process unfolds, the escalation becomes more pronounced. Credit rating agencies begin to adjust their assessments, reflecting the changing risk environment. Downgrades increase, particularly among companies that were already positioned near the lower end of investment-grade classifications. Each downgrade has consequences. It alters the pool of potential investors, triggers contractual conditions, and influences market perception. A single downgrade may not be disruptive, but a series of downgrades across multiple sectors can shift the overall tone of the market. At the same time, the cost of insuring against default reflected in credit default swap spreads begins to rise. This is another signal that risk is being repriced. Investors are no longer assuming stability. They are actively accounting for the possibility of failure. This shift in mindset is critical because it changes behavior. Risk management becomes more aggressive, exposure is reduced, and in some cases, positions are exited entirely. One of the most important, yet least visible, aspects of this stage is the role of refinancing walls. Corporate debt is distributed across time, with different maturities scheduled over the coming years. When large volumes of debt are set to mature within a relatively short period, companies face concentrated refinancing needs. Under favorable conditions, this is manageable. Under constrained conditions, it becomes a bottleneck. Companies must compete for limited capital, often accepting higher costs or less favorable terms. This concentration of maturities creates a form of temporal risk. The system may appear stable until a significant portion of debt approaches maturity simultaneously. At that point, the pressure intensifies. Companies that are unable to refinance on acceptable terms may be forced to take alternative actions, asset sales, restructuring, or in more severe cases, default. These outcomes are not isolated events. They contribute to broader market dynamics, influencing pricing, sentiment, and behavior. The psychological dimension becomes even more pronounced as these developments unfold. Market participants are highly sensitive to signals of stress, particularly when those signals align with existing concerns. Negative information is processed quickly and often amplified. This is not necessarily irrational. In uncertain environments, the cost of underestimating risk is perceived to be higher than the cost of overestimating it. As a result, behavior tends to skew toward caution, sometimes to the point of withdrawal. This shift in psychology feeds back into the system, reinforcing the conditions that created it. Reduced risk appetite leads to tighter credit conditions, which in turn increases stress on borrowers. Increased stress generates more negative signals, further reducing risk appetite. This feedback loop can persist until an external factor intervenes or the system adjusts to a new equilibrium. The transition to the next phase is marked by a change in scale. What began as pressure on specific companies or sectors expands into a broader reassessment of corporate risk as a whole. Investors begin to question not just individual balance sheets, but the assumptions that underpin the entire period of debt expansion. Growth projections are revised, valuations are adjusted, strategies that once seemed optimal are re-evaluated under a different lens. At this point, the distinction between financial markets and the real economy becomes increasingly blurred. Corporate decisions influenced by debt constraints begin to affect employment, investment, and production. These effects are not immediate or uniform, but they accumulate over time. Reduced investment slows innovation and expansion. Cost-cutting measures affect wages and job security. These changes influence consumer behavior, which in turn feeds back into corporate performance. The system, which once operated on the expectation of continuous expansion, begins to adapt to conditions of constraint. This adaptation is not smooth. It involves adjustments at multiple levels: corporate, institutional, and individual. Some entities will navigate these changes successfully, restructuring their operations and stabilizing their finances. Others will not. The outcome is not determined solely by the amount of debt, but by the flexibility and resilience of each participant within the system. And as these adjustments take place, the broader question becomes unavoidable. Not whether the system can continue as it has, but how it will transform under the weight of conditions that no longer support its previous trajectory.